welcome you to the latest in the Advisor Live series. I'm a senior manager in our corporate finance practice, which assists clients in buying, selling, refinancing, reorganising, and indeed valuing their businesses. Our valuations group sits in our team, and we do a lot of routine valuation work with private and family-owned businesses. In addition, we have specific expertise in more technical areas, including growth shares, control premiums, messy shareholder deadlock scenarios, and thought leadership around intangible assets, particularly at the moment, the valuation of data assets. But back to today. Advisor Live is somewhere between a webinar, a podcast, and a training session. It's designed to be short and sweet and as interactive as possible. Given the numbers we have on the call, we have muted the microphones and ask that you contribute to the discussion via the chat box on the right-hand side of your screens. On the webinar today, I'm working for my colleague in the corporate finance team, Luke Morris. Luke and I will collate all of the questions as we go and plan to have a discussion around them as we get to the end of the session. Listeners will know that what we want to achieve with Advisor Live is something that's timely, relevant, easily digestible and engaging. So we've got 3 ground rules. We are doing these weekly or more frequently where events dictate, no more than 30 minutes, and we'll be as collaborative as possible and ensure that we follow up on all questions raised in real time and in summary at the end of the session. Hope you find Advisor Live useful and welcome any feedback to hello@scruttonbland.co.uk. But on with today's subject, the impact of COVID-19 on business valuations. Many businesses have experienced significant declines in trade as a result of the unprecedented impact of and market reaction to COVID-19. Some of these impacts may be tied to temporary factors and extreme volatility in the markets, while others reflect longer-lasting, permanent shifts in the business or industries in which these companies operate. This will affect financial reporting for companies with going concern and increasing area of focus for accountants and auditors alike. But the impact of COVID-19 also raises a number of valuation considerations to be mindful of, and that is what we are going to explore today. So business valuation really needs to be thought of in the context of a transaction, because it's a little bit like the house you live in. Value only becomes relevant when you're looking to sell. We think of these things as liquidity events. Liquidity in its most basic sense can be thought of the ability to turn something, an asset, into cash. So in many ways, a valuation is a hypothetical exercise most of the time. But you can think of understanding your business value, perhaps on an annual basis, as part of effective decision making. It is important to understand the drivers of value when considering both short-term and longer-term planning. If you understand these drivers, that is where the opportunity to work on them and enhance and maximize value. There are indeed some occasions where a business owner must have a business valuation. For example, as part of a buy or sell agreement, if legally required. Raising funds from banks or external investors. Ordinarily, the bank or investor will want some comfort that the thing they are putting their money into, investing into, is worth what they believe it is. Setting up employee share scheme requires a valuation for tax purpose, or indeed valuations are required for other tax reporting purposes, such as probate on an individual's death. Insurance claims, such as for business interruption, which may be particularly relevant at the moment, are usually supported by valuations for the loss adjuster to do their calculations. Shareholder and commercial disputes often end up in a more formal process where an independent valuation is needed. And of course, the financial settlement aspects of a divorce, which, if you believe what you read in the Daily Mail, are expected to increase the longer we remain in lockdown. There are occasions where a business valuation is not essential, but very worthwhile. For example, in assessing the speculative approach to buying a business, and assessing how to increase the value of a business or an investment opportunity, or in considering how a change or restructuring of the business might impact on that valuation. For proactive succession or estate planning, planning for retirement, an exit or an acquisition, we always say that business owners have a choice. You leave vertically or horizontally. Ultimately, shares will change hands one way or the other in the future. Getting on the front foot and planning for that eventuality is preferential to allowing events to take their course. Qualifying businesses and life insurance will also need a business valuation, as indeed all key man and planning incentives for senior leadership will usually rely on some form of valuation. So there is a why for business valuation. Before we get on to COVID, let's take a look at some of the basic concepts in the Valuer's Toolbox. So that's over to you, Luke.
Thank you, Mark. Mark's been through there as to why you might need a valuation. It might have to be done, or it might be something that you can choose to do or would be advised to do. I'm going to talk about how we go about doing a valuation in practice, and then I'm going to talk about how the current situation is having implications for that how. So regardless of legal form, whether you're a limited company, an LLP, a partnership, or a sole trader, there are three types of business really as far as underlying cash flows are concerned. And I think of these as income stream businesses, investment businesses, and trading businesses. So an income stream business, I'm very much thinking there of a sole trader, a professional a service provider who's a one-man band, that sort of operation. I mean, think of maybe somebody who is a window cleaner. That individual, his or her business is essentially them. There's no goodwill attached to that business. If that individual stops working, then the business ceases. So you can think of the value of that business essentially as enshrined in the assets that they have built up, and nothing more. If they stop trading, then they have their balance sheet, and whatever's on the balance sheet is what that business is worth. Investment business. So this is not a trading business. This is something that's holding assets for capital return or for dividends or for a stream of rental. So there's no underlying trade. You know, you don't have inputs and processes and outputs and employees and all of that sort of stuff. You literally are just sitting on a pool of assets. I always think of the buy-to-let portfolio. It's probably the easiest one to think of. If we're looking at valuing a business like that, then what we do is we go straight to the underlying. We look at valuing what those assets are worth. So the obvious example is with our buy-to-lets, we look at what the properties are worth within that company, because it's usually within the company, and then we'll make an adjustment to account for the hypothetical tax costs of the shares of that company being sold. So it's very much looking at an adjusted balance sheet, looking at the value of the assets in today's money, and then doing a calculation to figure out what the tax implications would be if all of those assets were sold. So that's a pretty straightforward valuation too, but it might need to have some specialist input, for example, a surveyor or a land agent. Today, what we're really concerned with is the 95% probably of valuations we do, which are genuine trading businesses. So these are businesses that have those inputs, processes, and outputs. They have suppliers and customers, they have stock, and they have manufacturing processes possibly, or they have operational processes. That's what we're interested in talking about today, trading businesses, businesses that are set up with a view to making profits. And we have some first principles assumptions that we make when we are looking at trading businesses. The first thing that we consider is that the shareholders of such businesses are interested in cash returns. They are investors, and their first and foremost interest is getting a cash return on the underlying business. Now, it's very important to realize that there are something like 5 million small, medium-sized businesses in the UK. All of them are unique. So any valuation is case specific. And you can think of how you look at valuing a trading business almost in two parts. As of today, any trading business will have a balance sheet. And what that balance sheet essentially shows us is what that business has earned up to today's date, what the shareholders are entitled to as of today. So you can always think, if their shareholders decided that they wish to pack their bags and finish, liquidate the company and go home, that balance sheet, that gives you an idea of what that would be worth. It's almost like a liquidation value that you can think of. But what the balance sheet doesn't show us is what's in the future. And that's really where valuation gets interesting, because you probably will have heard of this concept or this thought of something called goodwill. And what goodwill really does, it tries to quantify or give an idea of what future earnings and future prospects of a business are. And that's really what valuers are interested in, is trying to estimate what is the value of goodwill, what is the value of the future. The accountants, the bean counters, have done the stuff from the past. They've got us to the balance sheet as of today, and we know that if we were to liquidate and cease operations, then that's what the business would be worth. The assumption that businesses continue on a going concern. So in order to get an accurate valuation, we have to add something called goodwill to that basic balance sheet value. And that's what we call a kind of price earnings type valuation. And that's what I'm going to talk about now. And that's difficult because we are inherently talking about the future. What are future earnings going to be? And there needs to be quite a bit of judgment applied by the valuer in determining what that is. So there are two factors that come into the vast majority of trading company valuations, two important bits of jargon that you might have heard of. The first bit of jargon we usually will refer to earnings or EBIT or EBITDA. So that is trying to understand and assess what is the future earnings capability of this business on a kind of maintainable basis. The second bit of jargon that we talk about is a multiple, and I'm going to talk about a multiple in a moment. Looking at earnings first, you're probably all familiar with your basic profit and loss account, where you have sales, cost of sales, gross profit, admin costs, distribution costs, taxes, and getting down to our net profit line. Now, you'll be aware, as people who've got experience of accounts, that there is a difference between cash flows and profits. And that's really where EBITDA comes in. Because remember what I said earlier, the investor in a business is really interested in cash returns. So EBITDA is a proxy. It's a quick and dirty way of figuring out operating cash flows of a business. Because what we take is our earnings before interest and before tax, which are not operational items. They are financing items and tax items. And we take it before depreciation and amortization, because those two items are not cash items. So we're doing a quick and dirty way of getting back to an operating cash flow measure. Why valuers like this number is because whilst it's possible with a myriad of accounting policies to put our profits and state them in different formats, in different company accounts, and apply different policies and so on, cash in and cash out is what it is. It kind of is what it says on the tin. You can't really play about with it too much. Cash is either there or it is not. And our investors are interested in cash. So that's why we use this metric. If we take a number of different companies side by side, it's quite easy for us to quickly figure out an earnings before interest, tax and depreciation and amortization from the sets of accounts. And that allows us to compare those companies like for like, and it's less subjective than a kind of a profit measure. Called a multiple. And what the multiple does, this basically takes a lot of information from the market and puts it into one number. I don't know if anybody plays around with stocks and shares, but if you own stocks or shares, there's something that's referred to as a price earnings ratio. When you look at your share price and you look at your share earnings, if you take the price and divide it by the earnings, what that figure gives you is the number of times the market is paying for every pound of earnings. So if you go to the back of the FT and you look at the price of a BP share, there will usually be a column that will have a price earnings ratio there as well. And that tells us what the market is paying for every pound of earnings of British Petroleum in that case. And the same is true in a private company valuation multiple. What the multiple is telling us, on average, what is the market paying for every pound of that maintainable earning figure? And that's quite useful for us as well, because we can compare multiples by industry, by size, by a different sector. And there's a lot of data that we can pull together, which I'm going to come to in a moment. So when we take our multiple and we multiply it by our EBITDA, that is giving us a method of determining the value of a trading business. It's not the equity value, it's not the value of the shares, it's something called the total enterprise value. And the reason for that is because investors in businesses can be both shareholders, but also they can be debt holders. So I could lend a business money as an investment as well as investing share capital. And what this calculation does, it gives us the total return to both of those types of investors. So it gives us an enterprise value. And you have to make an adjustment for the debt element to get back to the price of the shares. I'm not going to go into that today, but that's basically what it is. But you can think of this as a kind of almost like a price earnings type. Now, there's a lot of valuation science that goes into this. Broadly speaking, what it says is the best evidence for a multiple comes from the market. It comes from quoted prices. You know, if we're able to go to the back of the newspaper and we're able to pick out precisely what the share price of something is as of today, then that's great evidence of value. We can compare that to the earnings, and that gives us a really reliable multiple. For most private companies, of course, we can't do that. So what we do instead is we will use market inputs instead of quoted prices. And that's normally how it works for the work that we do with private trading companies. And just to give you an illustration, where we get some of this input from, there's lots and lots of information out there, lots and lots of databases out there. So I've put a slide up there, which is one of the particular sources called the PERDA database. And what those guys do is that they collate and summarize all kinds of information from all different sectors of transactions that have happened. Now, I've put the not quite current market because the problem with most financial information being submitted, as you all know, you submit your accounts 9 months after the end of the year. So it's historic data. But what it does give us here is a really interesting trend. And what this graph is showing, broadly speaking, over the last 10 to 13 years, the multiples being paid on average across the whole piece for private companies in the UK are kind of oscillating around that 6 times level. What's really interesting, point you to the beginning of that graph around December 7, you can see how we were getting up to 7.5 times. And then we had the financial crisis in 2008, and you can see we're down there to probably 4.25 times on average. So that gives you an idea of the variability of multiples in the market. I'll come back to that in a moment. Data showing us, and I'll read this slide out quickly. We're seeing that these multiples have fallen in the second half of 2018 and fallen in the third quarter of 2019 as well. So we're seeing a general decline, and a general decline below the 10-year average. So you're seeing a general falling off of prices being paid for businesses. And, this is probably something that we've been noting for a number of years running up to the current time. We're kind of in a cycle in an economy, and we were heading into sort of recession times anyway. So that's kind of borne out by some of the data of the prices that people are paying for private businesses in the UK. This is quite an interesting graph as well, because what this is showing is not multiple data. It's not how much money is being paid for businesses. This is showing the volume of transactions, the volume of deal completions per quarter. So again, I'll point out where we have a peak there, nearly up to 1,300 transactions around 2008. We had that financial crisis, and the number of deal completions almost fell in half. And over the last 10 years, that's slowly and gradually been sort of tickling back up again until it's probably in line with some of the measures the government have been taking around austerity and so on. But now we're here at the beginning or middle of 2020, and I think we're set to have a repeat of that fall off that we see at the beginning of 2008 there on that graph. So that's something to keep in mind. So the points I wanted to make is we've seen that it's the nature of business valuation, that what's really important is the future and the considerations around multiples. And there's an implicit assumption that a business will carry on in perpetuity, that it will go on forever. Now, with such time horizons in place, it's quite interesting in the current situation that we're careful not to be too influenced by the immediacy of an environment that seems to be changing by the day. And I'm very careful to try and be cautious with some of my thinking here. But there are some factors that we cannot ignore, which will bear down very heavily on business valuations at the present time. And my glass, I'm afraid, is pretty half empty with some of this stuff, because I think if you look at the three major factors, a lot of businesses are seeing that there's a major hole blown into demand and cash flows in 2020. I think we're all sat here feeling fairly uncertain as to the pathway to recovery, not just of our businesses, but generally of the UK economy. And we cannot ignore the huge intervention of government, central banks, in terms of some of the fiscal stimulus that's been put in place. So from a valuation perspective, these facts and the mathematics is undeniable. The money that we have lost today has a bigger impact. It's more immediate in our valuation calculations than any potential return of profitability in the future. And the fact that we're sat here with quite some uncertainty as to what the future looks like plays into our projections of cash and our projections of future earnings. Now, Mark's a bit more sanguine than I am on all of this, and you know, I think you do have to look at different business sectors that are likely to recover at different speeds and at different paces. But you know, there is that risk that we could be plagued by further lockdowns in the future. And I think when you have such a set of unknowns like this, you have to be cautious, and you have to be very, very careful. Now, what this means, the graph I showed earlier that was showing plotting those multiples, there's going to be pressure placed on those valuation multiples. In technical valuation terms, what that means is that the cost of capital is increasing, i.e., investors will expect to see more return for every pound that they invest. And they are doing that because they're factoring in all of these risks. So that's something we expect to see. I guess a trend at least like what we saw with the 2008 trend on those graphs. I think just on the macroeconomic facts, we saw in 2008 and 2009 that there were some costs of economic stimulus, and those costs come at a time when government revenues plummet as well. So you've got kind of a double-edged sword here, really, because we've seen in the last few weeks the Chancellor has spent around £300 billion on various stimulus packages. But he's doing that at a time when businesses are projected to make less profit, so there's going to be less tax take by the government. So it's kind of a double whammy. And the way that the government deals with that is by incurring more debt and increasing taxes. If we look back at what we can learn from the 2008 crisis, some numbers for you. The government debt increased from 43% of GDP to 85% in 2019, so pre-COVID. And we were already seeing at the end of 2019 some pressure on corporate valuations. With the impact of this 2020 virtual closure of economic activity, it's inevitable that that debt is going to go over 100% of GDP. And whatever your politics, there's going to be an imperative on governments in the future to look somehow to reduce the debt. Have we been here before? Yes, we have. World War II, the government debt stood at well over 200%. But what we can learn from that is for the subsequent 40 years, the reduction of that debt had an underlying depressive effect on the economy. It's demand out of the economy. So the idea of it's kind of the opposite to what governments do to win elections. To win elections, government increases government spending and reduces taxes as a means of stimulating economic activity. against the backdrop of a high debt type scenario, the government is probably more likely to increase taxes and to be more likely to try and reduce expenditure wherever it can, therefore sucking demand out of the economy. The reason I'm going on about all of this is because all of these factors feed into businesses' assessments and independent valuers' assessments of future maintainable earnings of companies. And if it feeds into the assessment of what a business is likely to earn in the future, then that's going to have an implication for that equation, multiple times future earnings, and that is going to have a suppressive effect on business valuations in the years to come. What do you think, Mark? You think I'm too negative, don't you?
Yeah, thanks for that upbeat message, Luke. I guess whilst not disagreeing with you, I'm going to come at this as a slightly different angle. I think there is a widespread perception that business valuations will fall, but as with every rule, there will be exceptions. Read a couple of articles at the weekend referring to previous global events, one of which was the SARS pandemic in 2003, which led to the explosive growth of Alibaba in Asia. We had the 2008 crash, which led to so-called asset-sharing companies such as Uber and Airbnb coming to fore. I thought I had this morning, if you think about the way we use cars now, this pandemic could be a huge turning point for companies such as Zipcar if the daily commute is now a thing of the past. I'm not suggesting the next Alibaba is watching this, but my point is there will be specific sectors where valuations will increase as a result of this pandemic. I just want to talk through those a bit more. The areas where I see multiples increasing are those that almost encompass our basic needs. I think youngsters might term this as wanting less stuff. One of the sectors I've done a lot of work in is with health providers. I think we can all agree that never has health been such a valued commodity, and the people that work in that sector have been so appreciated. I see some changes where healthcare that is often paid for privately is very much a hands-on sector, such as physiotherapy, will require some initial challenges in making delivery safe. But once these challenges are met, I can see earnings multiples increasing. Put simply, if we all become a more active society, the aches and pains will increase, as will the wishes of us to be more physically at our peak. This is not a platform to discuss future funding of the NHS, but I think what we will see is an increase in those prepared to pay privately for all sorts of medical treatment. And what part the likes of Bupa, for example, play in this is to be seen. What I do see is I might be more willing to spend £1,000 on a medical check as opposed to £1,000 on the latest iPhone. This will also impact on suppliers to the healthcare sector. Whilst I think people generally think of the suppliers as being the big multinationals, there are a huge number of small and family-owned businesses that supply to the healthcare sector, from the supply of diagnostic tests to plastic components for medical machines. These businesses are very often at the forefront of technology and quick to adapt to changing needs, for example, testing kits for COVID-19. Other area I see some potential upside is the area of home improvements. Clearly, we're all spending more time at home at the moment, and it's clear for many of us that are used to working in office, this will continue for some considerable time. And where I see this upside is that those businesses supplying home maintenance, building work, architectural work, home furnishings will all see an increase in demand. We're all used to spending more time at home and seeing all of the improvements our homes need. Some home improvements will require a team coming to your house, but others will perhaps just require delivery of a commodity. Clearly, the downside of this is that there are those businesses that have made their earnings from supplying services to commercial properties. I think that may see a fall in value simply because those commercial properties will be fewer and far between and they'll be less used. I think the other main area, which I'm sure we're all aware of, is improving the online experience. I think in many instances, if you're not already online and making it work for you, then it's probably too late. For example, it's difficult to imagine anyone launching yet another online fitness program or even a virtual travel experience, which most of them I struggle to see the pleasure in. What I do see is everyone's demands from their online experiences increasing. I think businesses that can balance the online delivery model with what would be perceived as added value will see an increase in earnings and therefore multiples. A good example of this might be Laithwaite's Wine, who have reported a huge increase in new customers since lockdown, and will be exploring ways of retaining these customers, for example, online wine tastings, meet the vineyard owner, etc., etc. When we return to the supermarkets in our hordes, if Laithwaites can reduce the footfall in the wine aisle, they will see earnings increase and multiples. Having said all of this, there is a huge caveat to this. What no one can be sure of is how long the impact of COVID-19 or subsequent versions thereof will last. If at Christmas 2021 the high street and pubs are full to overflowing, then probably fair to say the repercussions of COVID-19 have been overestimated. If, however, at Christmas 2021 the high streets remain empty and the pubs have closed, then clearly things have changed. What is certain is the economy will rebound, but it's where we spend our money and what on that will be different. As always, those businesses that can respond quickly to those changes and catch the public mood will be the ones that benefit the most. It is those businesses that will beneficially be impacted as a result of COVID-19.
Thanks very much, Mark. I was just wondering if there's any questions. There doesn't seem to be any questions in the chat box there. I think it's interesting, isn't it, how some of the sectors are looking to do very well. I was talking with a former colleague of mine who's just invested in a Peloton, one of these spin bikes. That's another example, a bit like, it's sort of tying into sort of online experience, but also healthcare, fitness, more time at home. And it's just going to be redeployment of disposable income, isn't there? But I think if it's difficult to pull out, I sort of looked at it on average, really. And if I just go back to this slide here, I think, that sort of decline that we see just after the 2008 financial crisis, when we're up at about 7.5 times, and this is all average data, so this is hundreds of private company transactions over all different industries across the UK. But it was up at about 7.5 times. And then we had that sort of shock to the economy, and we sort of see it go down to maybe 4.5 times. So so 3 times. If you think of you can sort of think of your own earnings of your business. And if within a space of 2 or 3 years, you're losing 3 times earnings sliced off the valuation, I think, economists are saying that the impact of the current situation, is at least as big, if not bigger, as that occasion in 2008, and the bailout is of a similar order of magnitude, albeit the bailouts coming through to businesses through furlough payments and so on and so forth, rather than to the banks. You're seeing that sort of change, and I would have thought, given the stability of multiples since then, if you look at 2010 to 2019, that's probably the order of on average, right? On average, that we're going to see. I guess there's going to be bigger winners and bigger losers, but on average, that's what we are expecting to see. I mean, do you have any thoughts on that?
I think that's right. I think what we will see is a far, far bigger gap between the highest multiples and the lowest multiples, because there'll be some businesses that are extremely successful as a result of this and could be looking at multiples approaching 9, 10. Equally, there are others that could dip to below 2. But I think the really interesting factor is that it's going to be at least 12 months before we get a firm indication as what's happening to these market values and the multiples.
Okay, well, thank you, Mark. I think we're probably over our time, and as there haven't been any other questions that have come in, I think we'll probably call it a day there. If you do have a question, anything from the material that we've been through in the last 30 minutes that's of interest, or you want to ask us offline, you can reach us at the email address there, hello@scruttonbland.co.uk, or the telephone number 0330 058 6559. Do stay in touch with us, do ask questions, because actually it's really helpful for us to inform the content and the topics that we talk about in the future. But I think all I have to say now, thank you, Mark. Thank you for your contrasting positivity to my negativity. I appreciate that. And we hope to see you all again very soon at another one of our Advisor Live events. Thank you very much.